Okay, welcome to lecture number 2 of ES 300, Energy and the Environment. Today we're going to tackle very basic accounting and project finance. So one note before I get to the main part of the lecture. At the beginning of each lecture, right after the title slide, there are going to be a list of questions. Not many of the questions will themselves appear on the final exam, but they are representative of the types of questions that will be on the final exam, and they would be good ones to study in preparation. So here are today's. What does it mean to finance new infrastructure? What is financial risk? And what does it mean for borrowing money? And then how can financing decisions and or financial risk impact the cost of energy for consumers? So first, really basic balance sheet accounting. A balance sheet is basically a snapshot of a firm's financial health before or after a performance period. So we could think about the calendar year as being broken up into 4 quarters. So you might hear about financial quarters if you're listening to NPR or PBS NewsHour or CNN or you're reading on the internet and Bloomberg or the Wall Street Journal. And so what this diagram is meant to show is that the yellow bars or rectangles represent the issuance of balance sheets. And so they're snapshots at the beginning and end of every financial quarter. And what's happening in the intervening period is that money's coming in, which we might refer to as revenues, and then also some money's going out, which we might refer to as expenses or costs. So balance sheets can be useful, in particular for understanding or providing some insight into a company's financial health. And it's important here, I think, to be specific about what I mean by financial health. In particular, it could refer to the profitability of a company, so the ability of a company to either distribute profits or dividends to shareholders or the people that own the company, or reinvest those profits in order to pay for some sort of expansion, to acquire new money or capital, in other words, to borrow money, and also to pay its bills on time. So a company may have already borrowed a lot of money and have acquired a significant amount of debt to pay for some sort of previous expansion or infrastructure. And now it may be responsible for paying back that debt over a period of time. And it's very important for companies to be able to pay back debt on time and reliably. So there are 2 parts to a balance sheet. There are assets and liabilities. And if you wanted to think about it in a really simplistic way, we might say that assets are the good stuff and liabilities are the bad stuff. So assets are sources of economic value. Examples might be cash or liquid money, as well as physical assets. So infrastructure that a company might own that does have value, but is not said to be liquid. So you can't use it to immediately sort of pay your bills. Liabilities represent sources of future costs or expenses. That could mean money that you owe your employees or outstanding debt. So if you have borrowed a lot of money in the past and you're responsible for paying it back at some point in the future, that is a liability or a future cost that a company would incur. So if we look at the left-hand side of a balance sheet, the assets, and subtract a company's liabilities on the right-hand side, what we're left with is called owner's equity. A company's equity is owned by what's called shareholders. So these are the people that own a company. And when we talk about a share, a stock share, that is simply a legal right to a piece of a company's equity. So that may bring up a question in your mind, or maybe not, which is, what do we mean when we talk about stock prices? Are stock prices simply equal to accounting equity? In other words, assets minus liabilities divided by the number of shares? And the answer there is no. Stock prices are not necessarily tied to owner's equity, or assets minus liabilities. Stock prices are a factor of the expected future earnings of a company, and that expectation is set by investors. And sometimes that's rational, and sometimes it's more emotional and psychological. So, if the market thinks that a company could do well in the future and be profitable, it may have a high stock price, even though it has low owner's equity. And if the market thinks that a company is not going to do well in the future, it may have a lower stock price. Another way of thinking about equity is that it's technically the amount of money that the owners of a company, again, the shareholders, would be left with if all the assets were liquefied or sold. So cash plus all the infrastructure. Imagine if you were a business and you owned a lot of factories or other types of infrastructure that had value, and you could sell them to someone. All the money that you could get for that infrastructure plus your cash, and then you pay off all your debts. That remaining amount of money would technically be the owner's equity. So low or even negative equity is not necessarily bad. Remember, balance sheets are just sort of a snapshot of a company's health. It might mean that a company just recently borrowed a lot of money, so they might have a lot more liabilities. Or maybe it means that they just distributed a lot of money or dividends to shareholders, so they have fewer cash assets. So we can't tell everything from balance sheets in terms of a company's health. However, if you saw really low equity, could be a warning, right? It could also mean that a company is losing money and has not been profitable. And it also might indicate that a company could have trouble paying their bills in the future. And we're going to return to this idea of having trouble paying your bills as an important concept in just a minute. So before we get to that, I want to ask a question, which is, how would an electric utility treat a power plant, a physical power plant, on their balance sheet? Where would it show up? And the answer is that it would show up in two different places. A power plant we would consider to be an asset. It has value because it can produce electricity that a utility could sell and make money. So it's a piece of infrastructure, and infrastructure ends up on the asset side of the balance sheet. It would also show up on the liability side, potentially as debt or money that the company borrowed in the past in order to pay for the construction of the power plant. So one really important thing to realize about the energy industry in general, especially the electric power industry, is that it is capital intensive. And you might hear me say that phrase a lot this semester. Capital intensive means that it costs a tremendous amount of money to build something. So electric utilities own and operate infrastructure that costs billions and billions of dollars. And so what that means for utilities' balance sheets is that they have a lot of infrastructure on the asset side, and they have a lot of debt on the liability side. And so what happens if Duke Energy wants to build a new power plant is that in year zero, in other words, the year when they want to start construction on the power plant, they borrow money from a lender. So not necessarily a single lender, a bank, but they borrow the money in year zero to build the power plant. And then what happens in year 1 through 25? And so we're imagining that in year 1 through 25, that's the lifetime of the power plant. The utility is using that power plant to sell electricity to customers, and customers deliver money to the utility. And then the utility can pay back the lender. And they don't just pay back the amount of money that it costs to build the power plant, they pay a little bit extra, and that's the interest on the money that they borrowed. So this is what we mean when we talk about infrastructure, especially electric power infrastructure, being financed. When you finance something, that means that you're funding it using borrowed money, and the borrowed money has to be paid back over a long period of time. The details here about how infrastructure is financed can have huge, huge impacts. Number one, it impacts the price of electricity for consumers. And number two, and this is perhaps more important for the objective that we talked about last time in terms of reducing carbon emissions, it can have really big impacts on strategic decisions about that utilities make. For example, about when to retire a coal plant and to replace it with something cleaner. A lot of that can be tied into the decisions to finance infrastructure, and we're going to talk more about that. So, where does the money to build power plants, for example, come from? And we talked, I referenced a lender, this mysterious lender, and I said it wasn't necessarily a bank. So, where does this money come from? So, in general, there are two sources of where electric utilities can get money, there's debt and equity. Debt is a contractual obligation to pay back money with interest. So, when we talk about borrowing money, that's usually what we're talking about is debt. And if you don't pay that money back, you go bankrupt, just sort of as a rule of thumb. Equity is a little bit different. Equity, as it sort of implies, is when a utility sort of borrows money from itself, right? So if there's owner's equity, so assets are larger than liabilities, and there's some cash that's been saved up that could be distributed to shareholders as a dividend, a utility might use some of that money to pay for new infrastructure. And so in this case, the utility is sort of borrowing money from itself, from the shareholders. Now, with equity, there's no firm obligation to pay that back. But there is a trade-off between debt and equity, and we're going to get to that a little bit later in this lecture.